Welcome to TheoTrade. This is Don Kaufman. It's March 24th, 2018, doing the Theo weekend update. Well, let's get started with the idea that, once again, we see some pretty epic volatility this week. The only thing you really have to compare it to recently would be going all the way back to January of 2016, which eventually saw the S&P's trade all the way down to the 1800 level. Now, not necessarily a comparison, but I am going to draw some interesting conclusions from some of the trade action that we saw this week. I mean, this week was just filled with potholes. You know, we started off with what we termed Fed 2.0. If you watched last weekend's update, really important, you know, if you're going to tune in at minimum to the weekend updates, because we hit the Fed 2.0 right on. We believed they were going to come out a little bit more hawkish. We were looking for sell-side activity after the Fed, and that's precisely what we got. On top of it this week, and you want to compound some of the risks, we had some Facebook quote-unquote issues throughout the course of the week, which really sparked, I think, fear in some of what we term the monsters of tech. Now, if you're not familiar with that term monsters of tech, well, it's just that. You know, it's your Amazon, it's your Google, it's your Apple, okay? Throw a little Microsoft in there, got a Facebook, and those underlyings were being hammered this week. Again, there's some fear rising inside of some of the monsters of tech, obviously sparked by Facebook. Last, but definitely not least, we've got trade issues right now, but people, listen, that's all in the past. And as a trader, you gotta always be forward looking. You know, I love volatility. I grew up in volatile markets. I can tell you this past week was pretty spectacular from trade opportunities, but let's be forward looking. Listen, when I say it's all in the past, okay, yeah, you got to make some decisions, but the decisions you have to make are moving forward. You know, number one thing you want to think to yourself right now is, and if I have a long portfolio, do I want to continue to be long that portfolio? And again, what can you kind of expect? Well, one thing I think that's imperative to recap, I don't want to go over the news. I don't want to talk about Facebook, okay? We're not going to look at a ton of individual underlyings here in a moment when we do bring up the charts. What we really need to be focused on right now is what your risk is moving forward. And for that, just one quick recap. The SPX, and you guys know on a week-to-week basis, I look at the SPX and I look at what's termed expected move. So this previous week's expected move, and that's the full 5 trading days that we just passed through, was sitting right around $45.60. All right, what does that mean? It means for the most part, the market was anticipating the SPX to move up or down 45 points. Well, how much did we move this past week? The S&P, and specifically the SPX, moved $164. Now, time out for a second, because whether you trade options or not, okay, we'll put that aside for a second. The option market was anticipating us to move $45. We moved $164. That equates, okay, to about 3.6 deviations. For those of you that don't want to talk sigmas, you know, the engineers, they get pretty excited about this stuff, but you're moving, you know, over 3.5 standard deviations from what we were supposed to. You got to realize that's how I define kind of an epic week in terms of volatility. But once again, you have to recognize the options market is not getting the risk right. It means some of the professionals out there, okay, are like, they're just not handicapping the risk correctly, all right? Markets are supply and demand. They're bids and offers. And the marketplace anticipated risk to be $45. What was the real risk? 164. I mean, that's not even hitting the broadside of a barn. Now, this is the important part, okay? A lot of you are going to think about coming out and trying to sell options premium. And again, some of you are not necessarily in tune with some option strategies, but that's neither here nor there, because I want to make a point for those of you, whether you trade options or not. But some of you are thinking, yeah, you know what? Some premiums are getting up there, right? And I'm thinking about selling some options. And I'm telling you, you have to come in right now. If you're going to sell option premium, with a very soft hand. That's going to mean really, really small contract size, because what I'm going to show you in a minute in the charts is pretty astounding. And it basically boils down to the idea of the market itself, the SPX, and a lot of the products right? Including, individual stocks and your Amazon, the products themselves in the SPX are moving more than what they're being implied to move. Now, when you go out the idea of trading options, in options you're either a buyer or a seller. But if you go out and sell an option, okay, and the option says we're only supposed to move 45 bucks and we move 164, you get run over. It's like, oh, I missed that freight train. That thing just right over me. But that's exactly what I'm, not implying. I'm telling you, the numbers are there. We started the week in the SPX at 27.52. That was last Saturday. I talked about 27.52. We ended the week, right, at 25.88 in the SPX. Again, 164-point move over 3.5 standard deviations, according to, again, implied volatility metrics. And people are coming out of the woodwork. One of the things that in terms of selling option premium, they're coming out of the woodwork. Now, one thing, as I said, if you do not sell option premium, you're not an options trader, that's okay. You have to look at this and just realize that there's an extraordinary amount of movement going on inside of the S&P. So I took that one to the test, and I actually looked back over 20 years. I wanted to see actual price movement. It's called historical volatility. It's the annualized standard deviation of the past stock price movement. If you have no idea what that means, it means actual price movement in the markets. And again, we're going to show you that here in a chart in just a moment. But what you find out is if you look back over the last 20 years, the marketplace right now, I was like, we're moving around a lot. Yeah, but according to some of the historic data, we're actually not moving nearly as much as I anticipated. Actual price movement is just above average going back about 20 years. And I found that interesting because, again, I've been doing this for 20 years, and that's why I look back 20 years, and it seems like there's a lot of price action right now. But the one thing that we all have to put in perspective is, a 60, a 70-point move inside of the SPX really isn't that much, okay? On a percentage basis, it's not that much because we have earlier this week, we had a $2,700 product. When you're looking at Amazon, you're like, oh, that thing's moving around 30, 40 bucks in a day. Yeah, but on a percentage basis, it's not that big. So what you'll see in a moment is we're gonna look on historical volatility terms, and you're gonna find out that the price action isn't that big. What am I implying? I'm implying, people, you could see way larger moves, and we have. When you start putting things into percentage terms, the indices, again, some of the biggest moves we've had since 2016, but the indices can get way more wild than this. 5 and 6%, moves inside of a day, and we're nowhere near that. So as a trader, okay, as an investor, you need to be able to quantify that to how much risk that you're taking. And another aspect I want to give before we go over to the charts, I want to give you another kind of a look at this. I want you to look at something like Amazon, for example. And we're going to pull up a chart on Amazon here in a few minutes, but I want you to look at a chart on Amazon. I just want you to bring it out, for 1 year. Do it yourself. Go look at something like Boeing, 1 year. Go look at something like Caterpillar, 1 year. And you start to look at those 3 or 4 products, and you start to realize, wow, Amazon, that thing hasn't even gotten back to where it was maybe in December, like 3-4 months ago. And you start to recognize, right, that the rally that we've had in the past and previous, let's call it 18 months, was so substantial that products like Amazon, which, was that a huge sell-off over here? It's nothing. It hasn't even skinned its knee yet. And I've said that a lot recently because if you look at Amazon coming all the way back down to 1,000, and I know that sounds like a crazy number, but Amazon was just trading at 1,000, again, a couple of weeks ago. All right, it's like 3.5 months ago, but that's still a couple of weeks ago. If you looked at the idea of Amazon coming back down to 1,000, do you have any idea what that would do to the Nasdaq 100 and the broader S&Ps? Okay, and it's things like that. Again, I'm not screaming here, there's risk, there's risk. In a moment, I'm going to show you, again, a number of trades, okay, that we're doing, a number of trades that I'm looking for, and we're going to talk extensively, again, about that sell side and do I really want to sell options premium? Thanks, everybody. Let's get to the charts.
All right, let's get to the charts. We're going to start with the SPX, looking a bit at the expected moves versus historical volatility, really right where we just left off. First and foremost, if you've never seen this SPX chart, the small hash marks on the screen are indicative of what we term expected move. Those expected moves are derived, okay, directly from the options market. What it says, okay, and I'll give you last week, for example. Last week, we're expecting right around a $46 move higher or a $46 move lower. Now, where does the $46 come from? Again, it comes from the option pricing, okay, in last week's chain. Now, what did we actually get? Well, actual movement was we were down about 164 points from the beginning of the week, again, to the end of the week. Now, you have to think about this for a second in terms of, I guess, a bit statistics. And not everybody is into this, okay? Not everybody necessarily is math geeks, but I'll draw it out for you here just briefly. If you look at this in the type of move that we have, here's a distribution curve. And we were expecting, again, this $46 move higher or lower, right? $46 higher, $46 lower. And what did we end up getting? 164, which is, you're out in this neighborhood over here. So this being like a 1 day, deviation, we got 2 deviations. We're out in like 3 deviations. As I said, you got about a 3.6, okay, kind of, sigma move last week. Now, there's some good and there's some bad. If you're an option trader, okay, one of the good aspects of a big move like that is that it's going to expand volatility moving forward. And again, the intent here is not to intimidate you. Well, first of all, you should be intimidated. A Friday afternoon, the S&P sell off by another 50 points after getting whacked hard the day before. Okay, you don't know what Monday is going to hold here. But one of the good aspects, I think, of the market getting hit and hit hard happened to be it expanded the volatility pretty drastically for this next week. And I want to show you this because there's some points I'm going to make with it. If you take a look, we have coming up only a 4 trading day week. Next Friday, again, next Friday happens to be Good Friday. The markets are going to be closed. So we've got Monday, Tuesday, Wednesday, Thursday, and by the Thursday expiration, and expiration is coming Thursday, we have right around a $77 expected move. So that is quite a large expansion. Again, the previous week, you're sitting, that 45, 46 bucks. Now we're up to $77 and a $77 move, but that's based on only 4 days. So you're seeing that volatility didn't quite double. So this is the thing, though, that it's actually bothersome to me. And I really want to hammer this because if you're taking a look, all right, and I'm just going to zoom out for a second. We're going to take a look now down below, and I was talking about historical volatility. Now, for those of you, again, if you have no idea what historical volatility is, it's actual price movement in the marketplace. And I took historical volatility all the way down to, if you're curious about this, the length in there is 5. And this is a daily, so it's 5 days, kind of average of historical volatility of 5 days. And what I wanted to show you is that the historical volatility, which is actual price movement in the markets, okay? Yeah, we saw some pretty good price movement, but that was back again in February. That's kind of right around that, February 9th bottom, that got up there. But look where we currently are. I know a lot of people are kind of panicking this week, and they're like, oh, it's happening. But the reality is, okay, we're moving. We're not exactly rocking though yet. And that's, again, markets had a pretty epic week in terms of volatility. But then when you start looking at historical volatility, kind of averaged over 5 days, right? And okay, I kind of get what he's saying here. In fact, what I've pulled up is this is a 20-year daily. Because if we zoom out for a second, we kind of can scroll back year in and year out, right? There are a lot of blips on the radar here where the volatility, the actual price movement is beyond double where it currently is. Again, if you take a look at the, this is where we currently are at, is right around 18, 19%. Draw a line anywhere back in the past. And I know we're looking back here, 2010, 2011, maybe 2012, 2013. Okay. But this is where we currently are. We're towards the higher end of the range, maybe for 2013. But again, when you start looking back in time, all right, you're going to find out the marketplace, clearly this is 2008. Let's just leave that one out. But you're still going to find out that the marketplace can get a heck of a lot more volatile than it currently is. And I'm not even talking about implied volatility. Again, we're talking about actual price movement. Actual price movement can get far more drastic than we are, again, currently seeing. And I just wanted to throw that out to you because, in some of the mathematics that I ran on this, I actually found something interesting. We're very close to the average of historical volatility, right? Moving back for 20 years, the average of historical volatility. We're not high, we're not low. We're kind of like just in the again, if you look at a standard deviation, we're kind of right in the meat of the curve of actual price movement. And that doesn't exactly leave me with a warm, fuzzy feeling. So one of the things I want to point out, volatility, it definitely expanded, okay, in this coming week. But overall, and I'm going to back away from the 5-day look. Overall, the VIX, this thing's catching its stride. We're not even at 25. And that's a little bit disconcerting. So as I raise this question, should you be buying options? You should be selling options. We're still transitioning. I still am looking forward at this, and I'm saying there needs to be, and I want to be crystal clear about this, I think there needs to be a very drastic, again, volatility shock to the marketplace, whereas a lot of people thought that this, back in February 5th and February 9th, they thought that was the volatility shock because a couple of the volatility products went up in flames. I don't think we've seen it yet. And I'll tell you why I don't think we've seen it. Because the implied volatilities in the SPX, okay, look at this. You can go out 32 days. These things are 24, 25%. Okay, implied volatility, still snoozing. You better think about that. Now, as I said, and I began with, if you look at stuff like Amazon, let's completely switch gears for just a moment. If you look at stuff like Amazon, and I'm not a big market technician, right? I don't think you need to be a big market technician. All I want you to do is open up an Amazon chart, okay? Do this on your own and just look at a 1-year chart and you start to realize, all right, Amazon's coming off here a little bit. This is not even a scrape on Amazon. You have to recognize Amazon just getting back to where it was back in December. Let's crazy talk. Oh no, it went back to where it was just a few months ago. The drop over here would be massive, and the impact that would have, okay, upon the Nasdaq could be pretty ugly. The other thing I want to bring up, and I think it's worth time. And again, when you look at this, Amazon still from a risk reward perspective, all right now, this underlying has a huge amount of risk. And I want to be clear about something. I'm not trying to pick on Amazon. Again, I want to be crystal clear about this as well. Okay. You have to realize that an underlying like Amazon is one of the most widely held products now, okay, amongst funds, mutual funds. So here's the bottom line with something like Amazon. If it's one of the most widely held products, if big mutual funds are going to have redemptions, you ever trade the Qs? Okay. The QQQ, right? You trade something like the Qs. If everybody starts selling the Qs, one of the largest products in the Qs is going to be Amazon. If there's sell-side activity, it's not about Amazon being a good company. It does not matter if it's a good company. They still have to sell it. Why? They have to sell it because it's one of the most widely held products. When a mutual fund redemption comes out and somebody says, I want my $200,000 out of the mutual fund, the mutual fund managers, they cannot sell with discretion. They just have to splash the pot and say, hey, we own some of the S&P 500. If they're heavily weighted into Amazon, which they absolutely are, okay, they have to hit Amazon the hardest. And again, you're seeing Amazon relatively unscathed, which tells me that sell-side activity, all right, it picked up a little bit this week, but we haven't seen anything yet. We haven't really seen sell-side kind of grip hold. And you have to realize, if you look at something like the Nasdaq, specifically the Qs, and again, here we are in a 1-year chart, okay? Let's just say that, something crazy happened. And this is not crazy. I'm being a little facetious. Let's say we went back to the levels that we were just this past summer, back to August, September levels, okay? And you realize how much more, okay, the Qs have to drop just to get back to that level. But again, I think what would be most advantageous if the Qs are going to continue to drop is to look at some of the stronger products. And it is going to be something like Amazon and Amazon out there. Or if you want, we can start picking on Adobe and a few others that, again, are fairly large market caps. Now, before I go any further here, I also want to recap a couple of trades. So this past week, we were trading extensively. As in terms of weeks, probably one of the top 10 weeks and executing in one of the top 10 weeks that I've had as a trader in 20 years. And I'll just show you a couple of the executions in here on some specific underlyings. This is all stuff that we mentioned on evening videos, and we're live within the chat room. If you look at, I'll start with Morgan Stanley. Okay, we positioned short into Morgan Stanley with a, this is an in-out put spread, and you can see I staggered contracts, all right, on the 19th and the 21st. Okay, going out there and purchasing this spread anywhere from 92 cents on up to $1. I exited the trade for about a 55%, gain. Okay, only again days later. So there's Morgan Stanley. I am out of the Morgan Stanley trades. Next, one that I mentioned numerous times, Intel. Again, you can see how I kind of staggered contract. Intel. On the 19th, 21st, and 22nd, I entered into a position. Average price in here is just shy of about 90 cents. I exited for $1.24. Why did I exit so early? Well, I mean, don't look the gift horse right in the mouth over here. I was up 30-40% within a day. Another one we mentioned on the evening video. This was, I think, on Wednesday. I entered into a Boeing spread. We bought that thing for $229, sold it for $320. Literally, this was not even a 24-hour trade on Boeing. Then we'll cruise over to Tesla because we know we mentioned Tesla quite often here. And, if you're looking at the Tesla spread, you're like, oh, what exactly went on in here? Okay, this is a Tesla spread now that we have gotten ourselves into, and I got to tell you, I like it at this point. The Tesla spread working really in our favor right now. This one has not been closed yet. Again, the Tesla spread, we went out and bought an in-out put spread. You can see some leftovers over here from a short call spread that I closed for 35-cent debit. But again, we've got an in-out put spread with Tesla falling. In fact, I wanted to take a moment and actually look at the Tesla chart with you. And pretty simply put, and again, I wasn't going to talk that much about equities. Tesla breaking below 300 looks like it's going to happen and look like it's going to be rather catastrophic as it does break through 300. All I wanted to denote on this one is that I've actually positioned myself a bit bearish in here. Listen, this spread's too late to get into. The thing is already up about 30%. Moving onward and upward. Other positions, I still have these on. Inside of Amazon. Now, I've got a number of bearish positions on in Amazon staggered. Okay, all of these positions right now are on the dance floor to be closed. They are, in fact, bearish positions in Amazon. It's not going to surprise me to see a bounce back, at some point during this next week, but it's always a possibility. Last but definitely not least, Netflix. A few bearish positions on inside of Netflix. Okay, on a percentage basis, we're doing extremely well. We still have 20 days left. And as you see, I've got positions in here, but you can't see the positions. That's because, people, they are in the money. They are in the money, and they're right, again, on the dance floor to being closed. All right, so we've got a really expanded expected move this next week, right? And there are option expirations for Monday, for Wednesday, and for Thursday. So it's not too ambiguous as to what some of the moves are likely to be, right? But look at this. On Monday, we have a $42 expected move. Do you realize that all of last week, we only had a $45 move for all 5 days? Here we are sitting with a $42 expected move on Monday. Now, as I said, I wanted to be really forward-looking, but the big final thought is that I think the easy part of this volatility is over. That basically means, listen, we saw some of the sell-side activity coming. We positioned ourselves very effectively. People, now it's going to get real. Now it's going to get a lot harder, okay? If you're not comfortable with the long positions that you're in, you must do something to mitigate your risk. We're looking at $42 moves. And I got to tell you, over a weekend, people are thinking to themselves already, don't worry, we're going to bounce on Monday. We're going to bounce possibly on Tuesday. You got to be nervous coming into a Monday with a $42 expected move. For one, I'm still thinking that we're in this transition where the option premium is picking up, but it's not spectacular, right? Again, 4 days and $77 of movement. But we just came off of a week where we saw $164 and $77 is the best we can do. You could get into some serious volatility these next couple of weeks. The other thing I want to point out, if you're taking a look at the financials, Okay, the financials are getting big and scary. This is a 44% implied volatility. Okay, what do I anticipate this next week? I'm going to tell you specifically. All right, I'm going to be looking at the bonds extensively. The bonds have threatened to start to really rally up. If those bonds do rally up, and again, that is now my immediate inclination. I think the market could still sell off and capital could rotate right to the bonds. The bonds start to get bid up, okay? The financials will get crushed. However, okay, there is a situation right now where the Nasdaq has been beaten up. A bounce is probably a bit overdue in here, but I feel like every trader is looking for that bounce and that we could see some fairly extraordinary sell side activity, right? You need to come into this next week, okay, very softly. If you're going to make a decision, you got to execute. Do not do any deer in the headlights. Be careful at the cash opens, okay? Order flow is going to be piling in on Monday. You can rest assured on Sunday when the futures reopen, these futures people, they're going to be rocking. Thanks everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.